In recent years, the real estate market has been a hotbed for investment, with many individuals looking to capitalize on the ever-changing dynamics of property ownership. Two of the most popular investment strategies in the real estate sector are flipping houses and buy and hold. Each has its unique advantages and risks, and the choice between them largely depends on market conditions, investor goals, financial capabilities, and long-term vision. As we approach 2025, it is important to take stock of the evolving real estate environment to determine which of these strategies stands out. To understand which strategy is more effective, we must break down the components of each, analyze the current market trends, and weigh the potential outcomes of both approaches. Let's first take a closer look at house flipping. Flipping houses, in essence, involves purchasing a property below market value, often distressed or in need of substantial repair, renovating it, and then selling it for a profit. This strategy relies heavily on timing, market knowledge, and the ability to manage renovation costs. The goal is a quick return, often within months, making it an attractive option for those looking for a short-term, high-reward investment. One of the key drivers of house flipping's appeal is the ability to leverage one's expertise in home renovation or the network of professionals available to facilitate the process. Real estate investors who are adept at evaluating properties, understanding renovation costs, and predicting market trends can make substantial profits in a relatively short period of time. The profit margins on flipped properties can be significant, sometimes exceeding 20–30% or more of the initial investment. However, this strategy is not without its challenges. The most notable risk when flipping houses is market volatility. If the market shifts unexpectedly during the flipping process, it can be difficult to sell the property for the expected profit. Real estate markets are cyclical, and regional differences play a big role in the success of flipping houses. Factors such as interest rates, economic growth, and supply and demand dynamics all influence the potential success of house flipping. Additionally, the renovation process itself can be fraught with complications. Budget overruns, delayed timelines, and unforeseen issues in the structure of the home can eat into potential profits. For example, a project that was originally expected to take 3 months could stretch into 6, further delaying returns. The cost of materials, labor shortages, and supply chain disruptions can all contribute to higher expenses, further decreasing profitability. Now let's turn our attention to the buy and hold strategy. Buy and hold real estate investing involves purchasing a property with the intent of renting it out and holding onto it for an extended period, often decades. The primary goal is to generate passive income through rental payments, while simultaneously benefiting from long-term property appreciation. Over time, the property may appreciate in value, and the investor can sell it for a significant profit once the market conditions are favorable. For many investors, the buy and hold strategy offers a sense of stability and predictability. With rental income, investors can cover their mortgage payments, property taxes, and maintenance costs, while also building equity in the property. The potential for steady cash flow through rent can be an attractive option, especially if the investor is focused on long-term wealth building rather than short-term profits. There are several advantages to buy and hold real estate investing. First, it provides consistent income through rental payments, which can increase over time due to inflation and rising rental rates. Second, as the property's mortgage is paid down over the years, the investor's equity in the home increases, creating wealth in the form of appreciated value. Third, the potential tax advantages of owning rental properties, such as depreciation deductions, can offer further financial benefits. However, buy and hold investing is not without its drawbacks. The biggest challenge is the management of the property. Being a landlord comes with its own set of responsibilities, from finding and screening tenants to handling repairs, maintenance, and legal issues. While some investors opt to hire property management companies to handle these tasks, the cost of outsourcing can eat into profits. Furthermore, while rental income is more stable than profits from house flipping, it can be inconsistent. Vacancies, late payments, or damage to the property can disrupt the cash flow. The investor may need to dip into personal savings or have a reserve fund to weather these occasional disruptions. Additionally, property values can fluctuate, and while the long-term trend has generally been upward, there are no guarantees that a property's value will increase at the anticipated rate. To determine which strategy might win in 2025, it's essential to consider the current state of the real estate market and the evolving trends that could influence these strategies. The market in 2025 is likely to look different from previous years due to a variety of factors, including economic conditions, interest rates, and demographic shifts. One of the most critical factors influencing real estate in 2025 will be interest rates. With the Federal Reserve and other central banks around the world adjusting rates in response to inflation and economic conditions, higher rates may make it more difficult for buyers to obtain financing. This could have a significant impact on house flipping, as higher interest rates would increase borrowing costs and reduce the number of potential buyers in the market. Flippers would need to account for these changes in their financial planning, as higher rates could erode profit margins. On the other hand, buy and hold investors could see long-term benefits if they secure financing at lower interest rates. Over time, as the real estate market stabilizes and rents increase, they could benefit from both the appreciation of the property and the rising rental. However, if interest rates remain high, the challenge for buy and hold investors will be the higher cost of borrowing, making it more difficult to acquire properties and maintain cash flow. Another significant trend to consider is the shift in demographics and lifestyle preferences. As remote work continues to be a viable option for many, we may see shifts in where people want to live. Cities that were once bustling urban centers may experience population declines as more people opt to live in suburban or rural areas where they can work remotely. This shift could provide new opportunities for both flipping houses and buy and hold investing, particularly in the suburban markets that are expected to experience increased demand. Furthermore, sustainability is becoming an increasingly important factor in both the construction and renovation of properties. Investors who are able to incorporate energy-efficient features, renewable energy sources, or eco-friendly designs into their properties may be able to capture a niche market that values sustainability. This could be an area where house flippers in particular can add value to a property by making green upgrades that can justify a higher selling price. On the flip side, buy and hold investors who make similar eco-friendly improvements could attract higher quality tenants and charge premium rents. In terms of which strategy is more favorable in 2025, it ultimately depends on the individual investor's preferences, financial situation, and risk tolerance. If you're looking for a quick, high-risk, high-reward investment and you have the expertise to navigate the renovation process, flipping houses might still be a solid choice. However, this strategy requires a keen understanding of local market dynamics, access to capital, and the ability to manage both time and costs effectively. For those with a longer-term horizon, a buy and hold strategy may provide a more stable, consistent path to wealth accumulation. The demand for rental properties is unlikely to decrease, especially in markets with strong job growth or significant demographic shifts. Additionally, rental income provides a steady cash flow, and property appreciation can offer substantial long-term gains. This strategy might be more appealing if you have a lower tolerance for risk and want a more hands-off approach, though it does come with its own set of challenges, such as property management and tenant issues. Ultimately, there is no one-size-fits-all answer to the question of which strategy wins in 2025. The real estate market is multifaceted, and each strategy has its own merits. Investors should carefully evaluate their financial goals, risk appetite, and the dynamics of the local real estate market before deciding which approach to take. Whether flipping houses or buying and holding, success in real estate investing comes down to research, timing, and execution. And for those who can adapt to changing market conditions and make informed decisions, both strategies can lead to lucrative opportunities in the years to come. Flipping houses is an investment strategy where individuals purchase properties at a lower price, often distressed, outdated, or in need of significant repairs, renovate them, and sell them for a profit. The concept behind house flipping is simple: buy low, fix up the property, and sell high. If done correctly, flipping can yield substantial returns, with profit margins often reaching 20–30% or more, depending on the market and the quality of the renovation work. This high reward aspect is one of the key attractions for investors who want to see significant financial returns in a short period of time. However, house flipping is also a high-risk strategy, and its success is deeply intertwined with the dynamics of the real estate market. Market conditions can fluctuate quickly, and a downturn during the renovation process can prevent an investor from selling the property at the desired price. Factors such as a sudden rise in interest rates, a housing market slowdown, or shifts in buyer demand can all lead to less favorable selling conditions, which can dramatically reduce profits or even result in a loss. Additionally, house flipping is dependent on effective renovation management. While it offers the potential for significant returns, it also comes with the challenge of managing time and costs. Renovation delays, unexpected structural issues, or rising material costs can eat into projected profits. A skilled eye for property evaluation, an understanding of renovation costs, and the ability to manage a tight timeline are crucial for maximizing the success of house flipping. Given the time-sensitive nature of the strategy, flipping houses is often better suited for investors who are comfortable with a higher level of risk and have the experience to navigate potential challenges. The buy and hold strategy is built around purchasing properties with the intention of holding on to them for an extended period while generating steady income through rental payments. Unlike flipping houses, which focuses on short-term gains, buy and hold investing is a long-term approach that allows investors to benefit from both consistent cash flow and potential appreciation in property value over time. The primary source of income comes from rental payments, which can cover expenses like mortgage payments, property taxes, and maintenance costs while providing the investor with passive income. In addition to this, the property's value may increase over the years, allowing the investor to sell it for a profit when the time is right. The long-term nature of the strategy offers greater stability compared to house flipping, as it is less affected by short-term market fluctuations. As long as rental demand remains strong, an investor can expect regular cash flow even in less favorable market conditions. This makes it an appealing option for those who are more interested in wealth building over time rather than immediate profits. Moreover, over time, as the mortgage on the property is paid down, the investor's equity in the property increases, potentially adding to their net worth. However, the buy and hold strategy is not without its challenges. One of the primary obstacles is property management. Being a landlord requires handling tenant issues, maintenance requests, and ensuring the property remains in good condition. Many investors choose to outsource these tasks to property management companies, but this comes at a cost, which can reduce overall profitability. Additionally, rental income can fluctuate due to factors as vacancies, late payments, or the need for repairs, which can disrupt the investor's cash flow. Despite these challenges, the buy and hold strategy is ideal for those who seek long-term financial growth and are comfortable with a more hands-off investment approach. As we look ahead to 2025, several key market trends are set to influence the success of both house flipping and buy and hold investment strategies. One of the most significant factors will be interest rates. If interest rates remain elevated, they could have a dual effect on these strategies. For house flipping, higher borrowing costs may diminish profitability by increasing the expense of financing renovations and reducing the pool of buyers who can afford to purchase flipped properties. Flippers typically rely on a robust market with strong buyer demand to sell quickly and at a premium, and higher rates could limit that demand, making it harder to achieve the desired returns. In this scenario, flippers would need to be more strategic in their property selection, focusing on areas with strong potential for price growth despite higher borrowing costs. On the other hand, buy and hold investors could potentially benefit from these higher interest rates. While acquiring new properties may be more expensive, once a property is secured, the investor can lock in a mortgage at a fixed rate. Over time, the rental market may remain stable or even thrive as prospective buyers are priced out of the market due to high mortgage rates. Additionally, remote work trends could play a role in boosting demand for rental properties, particularly in suburban and rural areas. As more people have the flexibility to work from home, they are increasingly seeking larger homes in areas with lower costs of living. This shift could present opportunities for buy and hold investors to acquire properties in up-and-coming markets where rental demand is growing. Another emerging trend is the increasing focus on sustainability and eco-friendly living. Both house flippers and buy and hold investors can capitalize on this shift by incorporating green upgrades into their properties. Sustainable building materials, energy-efficient systems, and renewable energy sources are becoming more attractive to buyers and renters, and properties with these features can command higher prices or rents. For house flippers, these upgrades can differentiate a property in a competitive market, while buy and hold investors may be able to attract environmentally conscious tenants willing to pay a premium for green living spaces. Ultimately, the market in 2025 will be shaped by these broader economic and demographic shifts, and investors who stay attuned to these trends will be better positioned to succeed in either strategy.